Survival of the fittest. It's a phrase we've all heard, but did you know this concept can be applied to your investments? Pulak Prasad, a visionary investor, has done just that. By blending the timeless wisdom of Charles Darwin with the dynamic world of finance, he has uncovered profound insights to help you navigate the financial jungle. Pulak Prasad is the founder of Nalanda Capital, founded in the year 2007, and has more than $5 billion asset under management. It has generated more than 20% average compounded returns net of fees and taxes for its investors, almost double that of Indian mid-cap and Nifty 50 index. Unlike your typical fund managers who buy and sell shares like toys, Nalanda Capital's investment philosophy is to be permanent owners of high-quality business. Let's dig down more into Pulak Prasad's approach of investing, about reimagining investing by applying the time-tested principles of biological evolution of Charles Darwin, and let's also see what a fox, a bee, or a deer can teach us about investing. This is the Better Investor, helping you achieve your financial goals by summarizing the best investment classics for you. And this is the first part of top 5 lessons from the book What I Learned About Investing from Darwin, written by Pulak Prasad. Lesson number 1. Avoiding big drawdowns. Imagine a thirsty deer approaching a watering hole. The deer knows it needs water to survive, but there's a risk. Predators like lions and crocodiles could be lying in wait. The deer faces 2 potential errors in its decision making. Type 1 error. The deer approaches the watering hole, but a predator is present. This is a mistake of commission, taking an action that results in harm. The cost, the deer loses its life. Type 2 error. The deer avoids the watering hole, even when no predator is there. This is a mistake of omission, not taking an action that could have benefited the deer. The cost, the deer remains thirsty, but it lives to see another day. Over millions of years, deers have evolved to minimize type 1 errors because the stakes are higher. Losing your life is far worse than missing one drink of water. This instinctual caution has allowed deer to thrive as a species despite living among predators. Now let's relate this to investing. A type 1 error in investing is when you commit to a bad investment, mistakenly believing it's a good one. The cost, you lose capital, sometimes permanently. Like investing in Yes Bank in 2018, only to see your investment sink. A type 2 error is when you avoid an investment that turns out to be a good one. The cost here is an opportunity loss. You miss out on potential gains, but your capital remains intact. You missed out on buying Tesla or Nvidia stock and they went to the moon. Just like the deer avoids watering hole to stay safe, investors should prioritize avoiding type 1 errors. It's better to miss a good opportunity than to lose your hard-earned money in a bad one. Pulak Prasad explains this beautifully using a simple mathematical example. Imagine there are 4,000 companies in the market, and out of these only 25%, that is 1,000, are good investments, while the remaining 3,000 are the bad ones. As an investor, you're not perfect, but let's assume you're pretty skilled. You correctly identify good and bad investments 80% of the time. Sounds impressive, right? But let's see what happens. Out of 1,000 good investments, you correctly select 800, that is 80%. And out of 3,000 bad investments, you mistakenly select 600, that is 20% of those. So, your total selected investments are 1,400. Out of these, 800 are good investments, which means the probability of making a good investment is just 57%. Surprising, isn't it? Even though you're right 80% of the time, nearly half of your picks could still be bad. Now let's see what happens if we work on reducing these errors. First, we tackle type 1 errors, the error of picking bad investments. If you reduce your type 1 error rate from 20% to 10%, you'll only mistakenly pick 300 bad investments instead of 600. You still correctly pick 800 good investments. That is 1100 investments total, and your probability of a good investment jumps to 73%. Wow! Now let's try reducing type 2 errors, the error of missing good investments. Lowering this error from 20 to 10% means you correctly identify 900 good investments instead of 800. But you still mistakenly select 600 bad investments, making your total investments 1500. The result? Your probability improves slightly to 60%, but not nearly as much as reducing type 1 errors. And if you reduce both errors, type 1 and type 2, to just 10%, that is, you now select 900 good investments and only 300 bad ones for a total of 1200 investments, your probability rises to 75%. Here's the key takeaway. While reducing both errors helps, the biggest improvement comes from focusing on type 1 errors, avoiding bad investments. That's why Pulak Prasad and many great investors emphasize the importance of saying no to risky opportunities. Lesson number 2. Where to begin? ROCE. Having shot down hundreds of businesses, you are now excited about selecting high quality businesses. You open your laptop, launch the application or website with data on companies, and then what? What do? For every company, you see a gazillion pieces of information on tap: revenue growth, profit growth, debt level, projected GDP growth, inflation, and many such readily available factors supposedly crucial for your buy decision. In short, where do you begin? One option would be to analyze each listed business after you have cast aside the high risk ones. The problem is that you do not have unlimited time. The number of companies may be in hundreds and you may need to spend months if not years to go through the entire list. Author gives a simple solution to this. Focus on ROCE, that is, return on capital employed. At its core, this ratio measures how efficiently a business uses its capital to generate profits. It answers two key questions. First, how good is the company at allocating its resources? And second, can it sustain this level of efficiency over time? Unlike superficial metrics like revenue growth or profit margins, return on capital employed gives you a holistic view of a company's operational and financial health. Pulak Prasad argues that high ROCE is a hallmark of great businesses because it reflects effective management, strong capital allocation, and the ability to reinvest profits into high return opportunities. For example, let's compare two businesses. One with a high ROCE of 25% and another with a low ROCE of 8%. Even if both have similar revenue growth, the first company is reinvesting its capital much more efficiently, generating higher returns for its shareholders. This efficiency often translates into sustained success, making ROCE a key metric for long-term investors. Here's how you can apply ROCE in your investment decisions. First, look for consistency. Focus on companies with a track record of consistently high ROCE, typically above 15 to 20%. Second, compare it within the industries. Use ROCE to compare companies in the same sector. A higher ROCE often indicates a competitive edge. And third, if a company's ROCE is declining over time, it could be a red flag indicating poor capital allocation. So you need to watch for trends. Pulak Prasad emphasizes that while ROCE isn't the only metric you should consider, however, it's still one of the most reliable starting points for identifying great businesses. Lesson number 3. Don't be impulsive. On October 27, 1997, the Dow Jones Industrial Average suffered one of its largest single-day drops in the history. It fell 554 points or 7.2%. For the first time in its history, the New York Stock Exchange halted trading. The proximate cause of this mayhem? The spreading of the Asian financial crisis. It had all started on 2nd July 1997 when the Thai government floated the baht since it did not have the foreign currency to support the baht's peg to the US dollar. This table tracks the US and UK market indices at the time along with stock prices of a few well-known businesses. Every number in the first column is negative. Why? Why did Walmart, a local US business, and Boeing, a global enterprise, fall on October 27? And why did Thai bond defaults impact Unilever, which earned about 70% of its revenue and profits from the developed world in 1997 and BP, a global oil company? This is proximate paranoia confused with ultimate reality. The evidence is in the second column, which provides the index levels and stock prices 6 months after October 27. The Dow as well as the FTSE were up 25%, and dramatic upward movement of companies like Walmart, Diageo and Unilever may have led to the firing of some fund managers who had pressed the panic button on October 27. Fund managers have Pavlovian reaction to macro or market data. Will interest rates be higher? Sell. Will inflation be lower? Buy. If the fiscal deficit shoots up, sell. Or is it a buy? Most businesses should be and are relatively immune to short-term macro movements. However, their share prices are not due to some reason. Let's go back to July 24 of 2002. The Dow soared 489 points, the second best point gain ever and the best percentage gain since 1987. The reason? Nobody knows, but there was some big macro news that news channels were displaying. Let's now look at this table on the markets and how stock prices in the United States and the United Kingdom reacted to this great news. As you can see, over the following 6 months, the Dow in the US shrugged off the gains of July 24, 2002 and declined by 2%. The significant upward moves in the share prices of large companies like Walmart, Citigroup and Boeing could not keep pace with the euphoria of this one day. Boeing declined by a fourth over the next 6 months. So what's the lesson here? Pulak Prasad explains that market movements are often driven by emotions, fear and greed and not by fundamentals. When we act impulsively during these moments, we're reacting to noise, not facts. Selling during a dip locks in your losses, while buying during a rally often means you're overpaying for stocks. In both cases, impulsivity causes you to act against your best interests. Markets have a way of self-correcting over time, and reacting to short-term swings only ensures that you miss out on long-term gains. Pulak Prasad emphasizes that patience is one of the most undervalued traits in investing. The examples of the Asian crisis and the post-rally correction reminds us that markets are cyclical and impulsive. They overreact in short term but often return to fundamentals in the long run. Lesson number 4. Stay away from predictions. One of the most popular tools in finance is the discounted cash flow analysis, DCF, where you estimate a company's future cash flows and discount them back to the present to calculate its value. Sounds scientific, right? Here's the problem. It's impossible to predict the future accurately. Pulak Prasad shares the story of a fund manager friend who valued businesses based on their projected earnings 2 years ahead. While this might sound logical, it's like trying to predict the weather in your city 2 years from today. It's pure guesswork. DCF models give the illusion of precision, but they're riddled with assumptions. If just one variable like growth rate or discount rate is off, the entire calculation collapses. Instead of relying on these shaky predictions, Pulak argues for focusing on tangible historical data. After all, the past is the only part of a business's performance that we can truly observe and analyze. At Nalanda, Pulak Prasad's investment management firm, they take a very different approach. Instead of predicting the future, they interpret the present in context of history. Looking at historical financial data, things like revenue, profit, and market share over the past 5 or 10 years. By analyzing how a business has performed historically, they can identify patterns, trends, and weaknesses. Here's why predictions are such a problem. First, markets are unpredictable. The stock market is influenced by countless factors, economics, politics, consumer behavior that are impossible to predict accurately. Second is the overconfidence bias. This is when investors often believe that their predictions are better than they really are, leading to risky decisions. And third is the missed opportunities. That is, by focusing on what might happen, you overlook what's already in front of you. Valuable insights from a company's history. Pulak Prasad reminds us that investing isn't about being a fortune teller. It's about being a disciplined observer. using data to understand the present and past and making informed decisions based on reality and not speculation. Lesson number 5. Convergence of business. Let's start with an analogy from nature. Have you ever wondered why dolphins and sharks look so similar, even though one is a mammal and the other is a fish? This phenomena is called convergent evolution, when unrelated species develop similar traits because they face the same environmental challenges. Pulak Prasad argues that the same principle applies to businesses. Whether it's a paint company in India, a tech giant in Silicon Valley, or a retailer in Europe, the most successful companies converge on similar traits to thrive. These traits often include operational efficiency, customer centricity, and strong capital allocation. The convergence is no accident. It's a sign that these traits are universal drivers of success. If you see a business with remarkable business in some other geography, chances are that it would do well in your geography as well. Many investors have been successful in doing this by looking at a successful business in America and replicating or cloning it in India. One example of this convergent pattern given in the book with the example of an internet job search platform. Globally, for example, Seek in Australia, Dice and Career Builder in US, 51 Jobs in China, Ian in Japan, and 104 Corp in Taiwan, and JobStreet in Singapore and Malaysia. These dominant franchises became more dominant each year. Their margin and return profile kept improving. They were all cash machines. The number 2 in any of these markets showed no signs of catching up, and LinkedIn and offline competitors had no impact on them. When the author's investment firm saw a business called Naukri.com list in India and into the same business, they hopped in 2013. Since then, their investment has given almost 30-fold returns over the past 11 years. DMart, another retail business in India, was similar to Walmart. Zomato and Swiggy, the two food delivery giants, are copies of DoorDash in US. And that's the lesson on convergence of business. Pulak Prasad's insight shows us that success leaves clues, and the best businesses often converge on the traits that work. Let's have a quick recap. Minimize type 1 errors to avoid large losses, as big mistakes are far costlier than missed opportunities in investing. Focus on companies with consistently high return on capital employed, as it reflects efficient capital allocation and strong management decisions. Resist emotional reactions to market volatility and instead adopt patience to ride out short-term noise for long-term gains. Avoid forecasting the future and rely on historical data and present fundamentals to make informed decisions. Look for businesses that adapt and evolve similar successful traits like efficiency and customer focus across industries and geographies. That's it, guys. If you liked the video, please like, share and subscribe. I will come again next week with the second part of this investing book. Until then, cheers guys.